It is such a privilege to have the four of you with us today. Greg, Howard, what a way to start this conference today. That was incredible. Thank you so much. We are now joined by Jean and Patrick, and we'll aim to take the discussion further. So if I interrupt any of you, please bear with me. This is just to make the most of the time that you have kindly given us. Jean, I'll start with you. So Greg and Howard ran through their investment philosophy and the need for an investment creed. You run Wellington, which can be seen as a federation of investment boutiques. What are really the advantages and the pitfalls of not having to have an overarching investment philosophy?
Thank you, and thank you for sharing all your insights. That was really fascinating. When I was sitting there listening, it made me think, you know, we have about 60 teams, like you said. We're not organized by one overarching philosophy and process. I guess our overarching philosophy and process is that we believe a philosophy and process is critical to the investment team. We have about 60 teams, and in each of those teams, we have a few in the audience today. Each of those teams have a very strong philosophy and process, very similar to what Greg and Howard do, and that's what they practice every day, and that's what they believe. We combine that at Wellington. I think every company has an edge. I think our edge is that we are really collaborative. So we have I've been at Wellington for 33 years. Over those 33 years, we have really broken down silos, and so that our long-only investors in equity collaborate with our fixed income colleagues, who collaborate with our private colleagues who do private assets and who do long-short. And that's the secret sauce. Like, how do we don't have one CIO, we have 600 CIOs, and we have normalized debates, having different perspectives on any topic. And then each of those teams can go and practice their very well thought out, strongly held beliefs about how they're going to make money for clients. That's how we're organized.
Very good. Patrick, I'll pull you into the conversation. Does the private nature of what you do have any direct implications on your investment process? Is there anything intrinsically different between private market investing and public market investing?
Well, I suppose, given my diminutive nature, I might sound like the poster child for private equity. But I'll say, look, I think private equity is an advantaged asset class if you're going to be in the investment business. And you sort of start with just the structure. You know, we have a 5-year investment period. We can have the money invested for 10, maybe 12 years. So we don't have to be invested all the time. You can pick your spots. That's a huge advantage. You get to do inside diligence. That's an absolutely huge advantage. You get to choose and select your management teams. You get to borrow money, and I've been doing this for 30 years, and I can remember, my first 15 years, you actually borrowed money with covenants, but for the last 15 years, we get lent money without covenants. So that's sort of extraordinary. You get to choose when you want to sell a business, and you get to have alignment, in the boardroom. It's sort of the investors and the management team. You get to choose 3 to 4 things that you really want to go for. I think that's a huge advantage. So as we think about sort of our own investment process and sort of managing risk, like Howard and Greg, talked about, it's really about being super micro-obsessed with the specifics of the business and ensuring that we, maintain our standards that way.
Mm-hmm. And you really invest for the long term, and that could be like a good segue into long-term investing. Greg, Howard, how does Investment Horizon fit into your investment philosophy and your philosophy creed?
Well, like Patrick says, maybe half of our assets are closed-end funds where you have the money for a period of time, and the great advantage is that the clients can't withdraw. So, people out of control of their situation love to buy when they're excited and sell when they're depressed. And this approach keeps them from doing so. That's one of the greatest advantage one can have in the investment business. I think that everybody at Oaktree understands our culture. We actually don't even have a tenet of our philosophy that talks about long-term investing. It's just understood. When I travel, especially to Europe, and people find out I'm in the investment business, they say, "Oh, what do you trade?" My back goes up. I said, we don't trade. Trading is guessing what something's going to do tomorrow. We're investors. We're in it for the long term. And I think that everybody on this stage is more of an investor than a trader. I don't understand how one gets an advantage in the short term.
Mm-hmm. Running such a systematic strategy, Greg, do you agree?
Well, I think the main thing is when I listen to Howard and what everybody on the stage is saying, I think the main thing is in the long term, you have to know what your advantage is. And that's the big thing, right? So for us, our time frame that we really understand well and we focus on is 6 to 18 months. So for some, that's very long term. For some, that's very short term. But 6 to 18 months is what we've thought really hard about and believe, despite Howard's thoughts on macro investing, that we have an edge in understanding what's happened in the world. Now, we are wrong a lot, to his point, and so you have to know how to be prepared for being wrong. And within macro, there's a lot of macro things going on, so you can diversify across many different things that you're talking about. But I think the starting point is that, and that the long term is going to work out if you know what your edge is, if you stick to it, if you're humble about it and you continue to learn. And long term is not going to work out if you're stuck on any particular thing that you might be wrong about and that you don't have a way of constantly improving and constantly learning. But for each of us, I think the main question is, what is the edge? Do you actually have it? And can you continue to improve it?
Mm-hmm. Jin, you are known as a very long-term investor in your portfolio manager days, which still one. How do you encourage your portfolio managers at Wellington to think long-term?
So part of it is our structure. Because we are a private partnership, we can incent investors, we can evaluate them, we develop them over long periods of time. So that structure enables that we are really paying our investors over, very aligned with our clients. I think that's one of the very key advantages. And then because we have 60 investors, like I'm one of the longest term, I'm probably very similar to Howard. I don't quite have a 12-year horizon, but I have a really low turnover. My turnover is 10 to 12%. It very much aligns with the industry that I invest in, which is a very long cycle, low turnover industry in healthcare. But there are others that have higher turnover, and so one of the things that we try to do is we do a lot of trading analytics. Are you making money off your trading if you have a shorter term time horizon? Back to what Greg said, what's your sweet spot of having insights and being able to. So there are some people who are fantastic who have high turnover, and then I strongly believe for me as an investor, having a low turnover strategy and really taking advantage of the insights I have over the long term is what has enabled me to do well over many years. But really having that self-awareness of how you generate insights, how you're going to make money for your clients with whatever asset class you have, I think is key to that.
Excellent. Howard, you touched on market efficiency and the importance of that. There's now endless information and a lot of noise in the market, but markets arguably become more efficient over time. So a question to both of you. How do you compare the alpha generation opportunity of your investment strategies now compared to, say, 10, 20 years ago?
I think it's gotten a lot harder over time, Pedro. You know, Warren Buffett talks about having bought dollars for 50 cents. 60 years ago, you could do that. 50, 40 years ago, I myself bought things that I thought, this can't exist. And yet, you got bargains virtually that couldn't miss. It's very hard today. If you think about it, everybody knows everything today. There's no such thing today as not knowing something if it's fact. Today, it's rather easy for portfolio managers to screen for securities that satisfy certain criteria. You know, you used to be able to buy companies for less than the cash in the till. We called that net investing. You can't do that anymore. And so, over time, knowledge is cumulative. Markets become more efficient. It has become harder to beat markets. Still, I believe some people can be superior. Their margin of superiority may shrink. Their workday may get longer. But I still think it's possible, but it becomes harder every day.
Yeah, I think, again, it depends on the nature. Like, even when you describe it 50 years ago, people could, but most people didn't, right? Like, even like at some point, having a calculator was an advantage, and obviously having a calculator is no longer an advantage. But I look at it a little differently. I think it's like the Indy 500 or whatever. The cars get better every year, so you have to get better every year, but there's still a winner. And so if you stay, if you don't get better, then for sure, any advantage will seep into general understanding. But if you continue to get better, it is like the Indy 500. And the core, at least the core things that I believe our alpha is generated from, really aren't changing much. I don't think we're getting any better as a species on things like love and fear and greed. Like, we keep doing the same things more or less over and over again. So I agree on things like calculating and arbitrage. That is like much easier to do. It's generally well known. Those things are not there anymore. But the fact that people are going to we all will, make really dumb mistakes, and if you have ways of understanding that and doing that, that continues. And when I look at the markets and the volatility of the prices relative to the fundamental conditions and whatever, it doesn't look like we're getting that much smarter. It's true on arbitrages are going away. I think that is the case. Things that you can calculate are going away. Things that are very hard to calculate seem as volatile as ever, and the miscalculations of human beings continue. So I don't know that, again, I would agree, if it's an established arbitrage, it will not exist it'll get learned, but other things continue more or less as they have through all human history, it appears to me.
Are there still more inefficiencies in private markets to be explored relative to public, and for how long?
I think private markets were 40 years now into institutionalization of private markets, and for sure private equity. I think that there, is a whole class of investing that goes on in my world where we buy from each other's portfolios because, why do you rob a bank? Because that's where the money is. So many assets are owned in private hands. So I look at Christian, we bought a business from you. Nick Humphreys is here from HG. We bought businesses from them. And what's really interesting is the return profile of buying things in the private markets, even from professional owners like sponsors, is really the same as it would be for a primary buyout. And so you sort of sit there and you ask yourself why, and I think it's a whole bunch of factors, including having a differentiated point of view, which Howard spoke about. It's having professionally trained management teams that really know what they're doing in terms of businesses. So I actually think right now there's a lot of inefficiencies in the public markets. I think there's a ton of really good businesses, but crummy stocks. 25% of the public markets or 50% are below their highs. So, in terms of my shopping list, I'm spending a little bit more time at the public markets right now because I think you get much more volatility in the public markets than you do in the private markets. Because when you're private, and if you don't have to sell, you don't sell.
Changing tack a bit, Greg talked about the power of compounding learning. Things may not always pan out the way that we think that they will. How do you institutionalize learning from mistakes in your organization?
So we do a number of things. Some short term. We have a daily meeting every day, and in that daily meeting, which happens in our London office between Asia and London, and in between Boston and our U.S. offices in London every day, we talk about all kinds of things, and including sometimes we talk about if something's happening in the market. What did you learn from the last time the market was like that, and what mistakes did you learn? So we do that. That's sort of a constant. And back to having different perspectives. There will be people that will come to our daily meeting and said, I got this wrong, and this is what I learned. So we've normalized sort of not being a star and not being right all the time, which is, as we know, being an investor, you're wrong quite often. So those are some of the things we do. And then we also do these things called lessons learned. So we would have someone who's been investing for 25 years or 30 years, and we ask them to be vulnerable. What really was the reason and the seminal moments in your investing career? And it's really about investing, these talks. Who they are as a person, what do they believe, and how are they investing? What are the 4 or 5 guideposts that sort of made their career, and those are all recorded, and people watch them and learn from them, and it gives you a good appreciation of just that people are human beings. We try to, we don't have a star culture, and the more people are willing to teach others and teach themselves, and as we know, you haven't learned everything Like I'm in my mid-50s. I've been investing for 33 years. I'm still learning. And so how do you make sure that that's part of the everyday language? So those are some of the sort of the things we do constantly over time that sort of normalizes the fact that you're making mistakes all the time.
Good. Howard, any views on the institutionalization of mistakes?
You know, we don't have a process for that. Your question suggests to me maybe that we should, and maybe
That's why I'm curious.
and maybe we will. But we have groups, as Jean says, and a high degree of independence. We're decentralized in our decision-making process, as long as, in our case, everybody follows the same philosophy and goal system. But we don't have a process for postmortems, and I think it's a good way to learn.
It's so critical to our philosophy, and to be clear, it's very hard because the thing that she's talking about was so important, which is the last thing you want to do is punish mistakes. You have to help people learn, and so we've struggled with the right institutionalization, but I've been institutionalizing this for a long time. So just to share quickly thoughts on it, I mean, the first thing I would say, if I were in anybody's organization that doesn't, like, having a real issue log is so valuable, and it actually works. Like, for us, it's very easy for people to enter issues. And again, when you think through what are the issues that matter, everybody's got issues, but the issues that matter to us are the things that are preventing you from achieving your goals. And so, to me, then having a diagnosis process that we let people, make it easy for people to enter and make it easy for people, like, to diagnose what's happening. There's two levels of that. There's the level of, like, in the org problems, but then you have this record you actually diagnose and decide, are you going to change anything as a result of this, right? It's easy to talk about problems, but are you actually changing anything? And oftentimes the right answer is, I'm not changing anything. Mistakes are a normal part of it, but knowing whether actively deciding, are we going to change something or are we not going to change something? Super important. So having a simple way for people to do that and see that it's actually happening is super important. Encouraging it mostly. Most important is that the most senior leaders, the CEO, the CIO, they're the ones getting issue logged, and they're the ones staring because they make the biggest, most important decisions. So making sure the arrow of accountability goes up, not down. Super critical lesson in our org. I think we had a lot of the arrow going down, and it was a big mistake. Encouraging the arrow of accountability to go up was a huge lesson in our organization. I'd change everything, I honestly believe. And then on the investment process, I mean, one of the great things back to systematic investing is we know on attribution every mistake, down to every data series, every little piece of logic, every data series. We know exactly why we got everything wrong. Like, speaking to his point about terrible macro investing, right? Mm-hmm. Like, I really thought we were going into a recession 2 years ago or so, and man, was I wrong, right? But okay, we learned something about the world that we didn't know. And by being able to attribute that to every line of reasoning, everything that we had ever learned that led us to that pretty strong conclusion, not so strong that was disastrous in the way he's saying, but pretty strong conclusion, knowing that we could easily be wrong, but but being able to attribute that to everything else, and then attribute, well, where did the money come from that prevented that recession? Attribute every one of those things, and what do you learn from that? Super, super critical thing to get right. And I would just say the thing I think everybody can do, and I would highly recommend, is have an issue log, diagnose important issues, get in the habit of it, and normalize it. It'll make the organization so much better.
Excellent. One last topic before we wrap up, specialization. So when investing, what are the trade-offs between specializing too much and missing the big picture?
Well, I used to have a yellowed clipping above my desk 50 years ago, orange, so it came from the FT. And it said that an analyst is somebody who knows a lot about a few things and learns more and more about less and less until he knows everything about nothing. A portfolio manager is somebody who knows a little bit about a lot of things and learns less and less about more and more until he knows nothing about everything. We have to bridge that gap. We have to know that there's information in our organization that some people have and other people need, and we have to get it to them. And the people who need it have to know that it exists and where. This is one of the greatest challenges in any organization. Greg described the way all of their learnings and findings are actually computerizable and computerized and shared. and I think it's a good idea. But how will the portfolio manager, who has to put together a large number of assets about which he knows less, ever get full advantage of the knowledge that the analysts who know so much about a few things have? And we struggle with it all the time. There's no easy answer.
Very good. We could go on forever, but we must finish now. We will take a break now. Refreshments will be served at the back in the canteen. For those of you watching live somewhere there, we will be back in the room at 1:45 p.m. But before closing, let me thank you all for spending the time with us in Oslo today. It was an immense pleasure to have the four of you in this panel. Please join me for a round of applause.